to Success Series. Today, we are going to talk about the Conceptual Framework for Financial Reporting. The Conceptual Framework for Financial Reporting 2018. Now, the Conceptual Framework for Financial Reporting is a basic document that sets the objectives and concepts for the general purpose financial reporting. It was first issued in 1989, then it was updated in 2010, and then it was finally completed in 2018. The current Conceptual Framework for Financial Reporting 2018 has 8 chapters. It has 8 chapters. These includes Chapter 1, the objective of a general purpose financial reporting. Chapter 2, the qualitative characteristics of a useful financial information. Chapter 3, the financial statement and the reporting entity. Chapter 4, the element of the financial statement. Chapter 5, the recognition and derecognition. Chapter 6, measurement. Chapter 7, presentation and disclosure. And finally, Chapter 8, concept of capital and capital maintenance. In today's video, we are going to look at 4 of these chapters. That's Chapter 1, Chapter 2, Chapter 3, and then Chapter 4. Now, let's start with Chapter 1, which is the objective of the general purpose financial reporting. This basically looks at we providing information about a reporting entity which will be useful to its existing or potential investors, lenders, and other creditors in order to help them to make their decisions. Now, what does this imply? This implies that investors need key information about the entity which will give them some assurance that their investment is safe. Lenders and other creditors also want to know how creditable the reporting entity is, and therefore will make them make a decision whether to give them their credit or not. Now, still under Chapter 1, we also have some general purpose reports, certain items or information which must be present in general purpose reports in order to help the investors, lenders, and other creditors to make their decisions. Take note that, however, these are well explained or deep explained as under the financial statement itself under Chapter 3. So here we are just looking at the general purpose report of them. So under the general purpose report, 2 major items are very key. We have the financial resources and its claims, which basically we can term as the assets and then our liabilities which must be present in our statements of financial position. And then we have these changes in economic resources and claims resulting from an entity's financial performance and from other events which may claim or which may group these items as mainly all the inflows in the form of incomes and all the outflows in the form of our expenses relating to these changes in our economic resources and claims. Let's move to Chapter 2. Chapter 2 is about the qualitative characteristics of a useful financial information. Now, under the conceptual framework, we have 2 major types of these characteristics. We have the fundamental qualitative characteristics, and then we have the enhancing qualitative characteristics. Let's start with the first one, fundamental qualitative characteristics. Now, with the fundamental qualitative characteristics are the basic qualitative characteristics of a useful financial information. These are very primal, very, very key. And there are 2. We have 2 of these fundamental qualitative characteristics. They are relevance and then faithful representation. Let's start with relevance. Now, with relevance, we are trying to say that your accounting information or your financial information should be capable of making a difference in the user's decision. So here, the information we need to provide should be able to influence the decision which will be made by users. And these are seen in 2 different lights. We are seeing that it should have first a predictive confirmatory value. What it means that this information should help us to predict some events, whereas the confirmatory value states that the information being provided should be able to help us to see that the things in the statement are what is actually on the ground. So you should be able to confirm the things in the organization, what is actually going on in the organization or in the reporting entity. So we will see that it should have either predictive value, confirmatory value, or it also will be having both. That is a predictive value and then the confirmatory value. Now, materiality, the concept of materiality is also related to relevance. So materiality is closely related to relevance. Now, the second fundamental qualitative characteristic we are going to look at is the faithful representation. Now, we say our information is faithfully represented when it's 1, complete, 2, neutral, and then 3, free from error. So when we say it's complete, what does it mean? It means that your financial information should be comprehensive in nature, being able to touch on the various needs or accounting needs or financial reporting needs of the users. What about neutral? We say that your information should be neutral, meaning that it should be free from bias. This means that your information should not be compromised by other factors. So it should be free from bias, any form of bias. And the third one is free from error. Here, when it says free from error, doesn't mean that there should not be any error in your statement. But it just means that the omissions, misstatements which are going to be made should the barest minimum, and these errors should not be material. That should not be key or detrimental. That will influence greatly the information or the decision which will be made by your users. Then move on to the enhancing qualitative characteristics. Now, under the enhancing qualitative characteristics, these characteristics are meant to complement the fundamental qualitative characteristics. Now, the enhancing qualitative characteristics are 4. We have the comparability, verifiability, timeliness, and then understandability. Now, let's start with comparability. Comparability implies that the information being given should be able to be compared between entities or different time periods. So when we talk of entity, it means that we should be able to compare our financial statements with entity A to entity B. So we should be able to compare between different entities. So entity A and then entity B. Or time period. Then when we look at time period, they are looking at just one entity. So one entity should be able to compare its financial statements for one particular year against another particular year. So yes, 2018 against 2019, or 2019 against 2020, and the likes. The next enhancing qualitative characteristics we are going to look at is verifiability. When we talk about verifiability, it means independent and knowledgeable observers should be able to verify the information. What it means is that the information being provided in our financial statement should correspond to what is actually in the organization. So any independent and knowledgeable observer should be able to see that, these things reflect the entity. It reflects the entity or shows the entity. Now, the next concept we are going to look at is timeliness. That's information here should be available in time to influence decisions of users. Now, information which is being provided should be able to help an entity, or it should be able to help users of an entity to make decisions in time. What does this imply? It implies that information that we have been given, if a user wants to make an information that is very important to him or her, based on the time it will come. Let's take an instance. When a user needs an information to be used in December, specifically for Christmas, and the information is being dragged to January, the information being dragged to January, the present information in January will not be useful to the user anymore, since it will affect the decision of the user, since the user needed that information to make a decision in December. Now let's look at the last enhancing qualitative characteristics, which is understandability. Here we say information should be classified, presented clearly and then concisely. What does this implies? Understandability basically means that any person who's having an average knowledge in financial statement or financial reports, basically in accounting, should be able to understand or comprehend the financial statement or the information provided on the financial statement. Now let's move to the next chapter, chapter 3, financial statement and the reporting entity. Financial statement and the reporting entity. Let's first begin with the first aspect, that's a financial statement. Now with a financial statement, we are saying an entity should provide financial statement about the following key items. The first financial statement to be considered is the statement of financial position. Here the statement of financial position moves in line with the accounting equation, and therefore we should recognize the assets, liabilities, and then equity of the organization. The second to consider is the statement of financial performance. Financial performance, we are trying to see whether we are going to make a profit or a loss on our statement. So here we are going to recognize any income and then expenses which we have made. Then we have the other statement, whereby some we need to present and others we need to disclose. So in the other statement, by presenting and disclosing information about, so we have other elements which may not be found in the statements of financial position and statements of financial performance. These includes the recognized and unrecognized assets, the recognized and unrecognized liabilities, some equities, incomes, expenses, and these are associated nature and their risks. Then we have cash flow. With the cash flow, we are looking at it in two perspectives. The cash incoming, which is called cash inflows, and then the cash outgoing, which is called cash outflow. This is mainly accounted for under the standard IAS 7. IAS 7, that's statement of cash flow. Then we have contributions from and distribution to equity holders. So this basically talks about the recording of transactions relating to any item of equity holders, that's the changes in equity. Then we have the various methods, the assumptions, judgment, use, and their changes. So any methodology, any assumption or assumption that the entity will adopt should also be disclosed appropriately. Then we have the second aspect of the chapter 3, which is the reporting entity. Now, reporting entity is basically defined as an entity who must or chooses to prepare a financial statement. So it's basically an entity who chooses to present financial statement. This entity may be seen as either a single entity, that's a whole comprehensive single entity, which may be just one company, or just a portion of that entity. So we are just looking at a division aspect of that entity or company. So we can talk of maybe the marketing aspect or probably the distribution of the production aspect. So I'm just talking about just one aspect of that entity, or it could just be more than one entity. And this is mainly in the light of a parent and a subsidiary, or whereby we have a combined kind of financial statement. Now, due to the nature of these entities, financial statements is also seen having the following types. We can group them based on what's consolidated, unconsolidated, and then we have the third one being the combined. Now, what does it mean when we say consolidated? Consolidated means we have a parent and a subsidiary reporting together as a single reporting entity. So here they prepare one single financial statement, and we call it what? A consolidated financial statement. Then we have the unconsolidated. Here is whereby the parent prepares their financial report, and the subsidiaries also do theirs differently. And we have the combined. With the combined, here is whereby two or more entities come together to prepare a single financial statement, and these entities are not linked in any way by any parent or subsidiary relationship. Chapter 4, which is the elements of the financial statement. Chapter 4, which is the element of the financial statement. We have 5 basic elements. These are assets, liabilities, equity, income, and then expenses. Let's start with the first one. But bear in mind that these definitions have been a bit updated in under the 2018 Conceptual Framework. So according to the 2018 Conceptual Framework, asset is defined as a present economic resource controlled by an entity as a result of past events. A present economic resource controlled by an entity as a result of a past event. Here, three major things should click on assets. There should be a present economic resource, there should be a control, and then the final one is there should be what? Past events. It should result from past events. Now let's move to liabilities. Liabilities is also defined under the Conceptual Framework as 2018 as a present obligation of the entity to transfer an economic resource as a result of past events. This is also seen in the light of three major perspectives: a present obligation, a transfer of economic resource, and then a third one, it's resulting from what? Past event. Now let's move to the next element, which is equity. Now equity here is defined in line with the accounting equation. So according to the accounting equation, you can basically define equity as just bringing your assets and deducting your various liabilities. So under the Conceptual Framework 2018, equity is defined as the residual interest in assets of the entity after deducting all its liabilities. Let's look at the next element, which is income. Now, income is seen as any increase in your assets or decreases in liability which results in an increase in equity other than contributions from equity holders. What does this imply? It implies that incomes are any values which result in a resultant increase on an upward evaluation of your assets, or which results in a downward valuation of your liabilities, or anything which will decrease your liabilities. And when this happens, it will result in an increase in equity. So when equity is being increased, we can consider an income is being generated, but all these incomes should not come from contributions from equity holders, or what you normally basically refer to as our shareholders. It shouldn't come from our shareholders or the equity holders. Now let's go to expenses. Expenses is the opposite of the income. So expenses is the decrease in assets or increase in liabilities, resulting in what? Decrease in equity other than distribution to equity holders. This implies that assets which decrease in value, anything which will decrease your assets in value, or anything which will increase your liability and therefore result in a decrease in your equity, is termed as what? Our expenses. So all these should not come from distributions. Any amount that we give to our equity holders should not come from any amount we intend to give to our equity holders or shareholders.